Thank you. Good afternoon, everyone. I'd like to call the meeting to order. I acknowledge that we're in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Innu Cree, and Dakota peoples, and the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation and Treaty 3 territory. My name is Neil Harden. I'm chairing today's panel. With me are Ethan Robson and Valerie Werhan. The assessor today is Nuwan Thudagala Munasingha, and the administrative personnel is Zachary Mohan. We'll be hearing applications for revision of the assessment rule in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application and will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by council and is independent of it in the city administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions the applicant may have, then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You'll receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We'll be hearing items 1 through 8 on our docket today. Mr. Mohan, please affirm the assessor's and applicant's testimony.
Of course, Mr. Chair. Mr. Assessor, please state your full name.
Nuwan Tudugala Munasinghage.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. Applicant, please state your full name.
Area Ralph Reimer.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
All right, thank you. Our first property on today's agenda is 295 Stradbrook Avenue. So, Mr. Assessor, you can begin your presentation.
Thank you, Mr. Chair. File number 241718, roll number 12031802500, 295 Stradbrook Avenue. Roll year 2025, reference date April 1st, 2023. Assess value 2,285,000. Classification 20 residential. Liability taxable. Number of building 1, 2-story building. Actual build year 1965. No effective year build add. Number of suites 16. Outdoor parking 10. And page 2. You can see a request for income information. You can see the subject property sales history. Yeah. And page 3, you can see the location and aerial picture of the property. Page 4, income value summary. Average monthly rent per unit, 1,111. Gross potential rent comes at 213,448. Vacancy rate 3.2%, and effective gross income comes at 206,618. Expense ratio 45.26%. Net operating income comes at 113,103. We have used a 4.95 capitalization rate. Based on that, the estimated market value comes at 2,285,000. Market value per suite 142,812. Page 5, rent comparable. You can see the average model rent supported by rent comparables. Page 6, you can see capitalization rate. In here, you can see multifamily capitalization rate bottom, high rise, low rise A, low rise B, all of them are 4.75 to 5.75. Sorry, 20% aisle, 4.75, 18% aisle, 5.45. And page 7, you can see capitalization rate evidence. These are the following is sample of actual sales that took place during the reference period. The purpose of showing these individual capitalization rate is to illustrate the accuracy of the model and substantiate the model-driven capitalization rate. They are not meant to be comparable specific to the subject property. So the model capitalization rate 4.95 supported by this capitalization rate, especially for 59 Sargent Avenue. Page 8, Municipal Assessment Act at Excerpt. Page 9, information and picture of the building. Also, page 10, you can see the exterior pictures, and page 11, interior pictures. It appears the unit has been renovated. And page 12, I have done the stabilization here. What I done, I got the effective gross income in here as an average, and then you can see in here which I get average in, and also I have to mention here something. You can see the effective gross income reduced from 2020 to 2022. It appears that they are doing some renovation. In here, they don't provide us any like vacancy or anything, so I can't talk about the vacancy rate, but I can see effective gross income is reducing. Normally, that's not normal. So, and also you can see the maintenance and repair. Their maintenance and repair double up from 2020. Maintenance and repair was 12,300, and it's increased rapidly. So actually, per unit basis, it's 1,768. It's very higher side. So basically, what I feel, they are doing a renovation there. Like if you see in the bottom, net operating income for each year supported by our model net operating income without the recent year, that means 2022. So next page, income and expense information, page 14 also that, and in page 15 you can see there are actual rent. If we multiply that actual rent, the potential, the actual rent comes at 223,200. So that's also supported our model gross potential rent. I have to mention here, in here, in our record, we have 16 suites, and but right now they have 17 units. I found I'll explain it at the beginning. I found the permit for that. Page 16 also income and expense information. Page 18, 19, up to page page 23, income and expense information, and page 24, you can see that permits what I refer to, that additional one unit. So basically, I believe this 2,285,000 is fair value for this property. This concludes my presentation. Thank you.
Okay, questions, Mr. Reimer?
Thanks, Mr. Chairman. Can I request there's going to be some questions and answers that are common to all the hearings relating to this afternoon relating to capitalization rate. I propose with your approval simply to ask them once and have those questions and answers carried forward, if I might.
Sure.
Thank you. So, Mr. Assessor, thank you very much for your submission and your evidence. Could we initially then go to your page 7, please? And that's the capitalization rate evidence that the department has provided this afternoon. On page 7, then, are you familiar with the rate, the guaranteed investment certificate rate as of the reference date in the 4.5% range? Were you aware of that?
Yeah, I heard. I mean, we discussed about that previous hearings.
Okay.
So, yeah.
So some of these rates, specifically looking at your comparables 1, 3, 4, and then the comparable lower down at 700 St. Mary's, those are all rates that were below the 4.5% guaranteed investment certificate.
Yes, the reason I mean, these are based on the actual sales and 3-year stabilization. This is what we got. So
right. No, I understand mathematically. I certainly understand how it works, Mr. Assessor. But I'd suggest to you that when you're talking about rates and specifically looking at Sargent at less than 3.5% versus the GIC rate, I'd suggest to you that there's something more involved, perhaps an intent to renovate with higher rents or that kind of modeling. But you've said you were aware of the 4.5% GIC rate, so that was really the question. With respect to going back briefly to 727 Sargent and 241 Young, and I guess that include 700 St. Mary's as well. The department, for all of these, the department hasn't provided you with the details of how the net operating income was arrived at and the stabilization, correct?
Yes, the reason is we can provide those information because of the privacy concern.
Okay.
That's why we don't provide those. But
Okay.
we are under oath, so we know we are do the correct calculation.
No, I understand, and certainly I'm not, to be clear, Mr. Assessor, don't get me wrong, I'm not suggesting that you've misrepresented this in any way, but put it this way, we can agree that the depending on the assumptions you make to calculate the net operating income, for instance, perhaps a bit different assumption for repairs and maintenance or the projected rents, all of those assumptions, right from the top line gross revenue through to the expenses that you select in the stabilization, if you make different assumptions in that calculation, that would in fact mathematically also impact the capitalization rate calculation, correct?
Yeah, that's right.
Okay. With respect to 150 Hendon, that is the third comparable, which we also have in our materials. Were you aware that I believe this transaction, yeah, it was on June the 2nd. Were you aware, or did you factor in the rental tenancies branch increases that were ordered just very shortly after that transaction?
Actually, I'm not sure about that, but I think what we have done, we stabilized 3-year income and expense. That means historical information, and
Certainly.
came with these numbers.
Certainly. Okay, I understand that. 677 Maryland, which is about halfway down the chart. That transaction that you've got there is from December of 2020. Were you aware that there was also a sale in March of 2023 on that property?
Yes, I know about that. We didn't took that information because we didn't got their income and expense information correctly. So that means they didn't provide it. So it's incomplete. Because of
Okay.
that, we don't got that information.
Okay, fair enough. So you didn't have the information that you needed in order to stabilize the updated capitalization or updated NOI and therefore the capitalization rate relating to the 2023 sale then, correct? If I'm understanding you correctly?
Yeah, basically we don't, I mean, we didn't get the recent sale because they didn't provide the enough information.
Okay, fair enough. Could I then ask you to turn briefly to your page 4?
Yes.
And so to be clear, on this calculation on page 4, that results in the value of 2,285,000. These are entirely model-driven values, right from the gross potential rent at the top line through vacancy, expense allowance, and capitalization rate. It's all model-driven, correct?
That's right.
Okay. Mr. Chairman, those are my questions. Thank you very much. And again, I'd ask that the questions and answers on the capitalization rate materials be carried forward, please. Thank you.
Okay. Mr. Robson, any questions? I think you may be muted there.
Sorry, I don't have any questions at this time, Mr. Chair.
Okay. Ms. Werhan, any questions?
Yes, I do. If you go to your rent comparables, I'm just wondering, sir, why you used comparable 1 and 2. They're both much older buildings.
So, I mean, that's what I can find for the that area. For so that's the reason. So, basically, yeah. Only, I mean, I found these, so I thought this is good. That's why I just put. I couldn't find the exactly 1965 building to compare, so that's why I put 1987 one and like a range to give an idea.
Okay, and they're both the number of units. I mean, they're larger buildings, right? And the number of units are different. So was that taken into consideration at any point in your presentation?
Yeah, like if you look at the gross floor area, the third comparable a little bit smaller than the subject. So, I mean, I try my best to give the like perfect one to subject property. That's what I found.
Okay, thank you very much. No more, Mr. Chair. Thank you.
Okay, thank you. And I have no questions that haven't been asked, so you can proceed, Mr. Reimer.
Thanks, Mr. Chairman. So ask for your advice here. I've got some rebuttal to the department's capitalization rate. Shall I present that after my submission and after questions, or?
Yep, our procedure is to do your presentation first, followed by questions, and then your rebuttal.
I have a
Perfect.
question
All right.
too. I have rebuttal too.
Yep,
Do it.
your rebuttal will follow Mr.
Yeah,
Reimer's
okay.
rebuttal.
Sure, thanks.
So, Mr. Chairman, in light, and I appreciate, and Mr. Assessor, I'm going to call you Mr. Assessor because I'm not going to get your name right, so I'll just use that term. The assessors provided some information concerning an additional suite, which I gather was a suite in the basement, and I had not included that in our calculation. So here's what I'm going to suggest for the purposes of the hearing. Could we briefly turn to my page 15, please? So in order to account for that additional unit, factoring into the NOI, of course, after essentially adding the potential gross rent and then deducting an expense ratio that would be comparable to the expense ratio that I show on page 15, which is in the 46.5% range. I'm going to amend my request, Mr. Chairman, to account for that. The way I'm going to do that, notwithstanding that, I'm guessing it would be less than this amount, but I'm just simply going to apply the assessor's NOI. We weren't that far off to begin with. We were about $13,000 difference. So I'm going to apply just add the 13,000 to my NOI based on the assumption that two-bedroom unit basement rental unit would net out somewhere in the $1,000 to $1,100 a month range. It's probably a little bit high, but I'm just going to do it for simplicity. So then please, the panel members and Mr. Assessor, if you might amend my request on page 15, I will just calculate that right now. So I'm taking the 113,103 and I'm suggesting still our capitalization rate of 575. And that revised value is then $1,967,008, rounded to $1,967,000, please. So then with that said, Mr. Chairman, the entire debate revolves around capitalization rate, and that's again going to be a common theme in the appeals that are scheduled for this afternoon. So if I could ask the board members and Mr. Assessor to turn to our capitalization rate study, and Mr. Chairman, if you might let me know when you're there.
Okay. I am there.
Okay. I'm not going to go into this in a lot of detail for the sake of trying to make this as efficient as possible. And I'm guessing Mr. Assessor and yourselves are quite familiar with it, but I do want to highlight a few things. Could I ask the board members and Mr. Assessor, please, initially to turn to page 4 of that study? And so at the top of page 4, we've got a couple of quotes, and this becomes important in the context of a couple of the calculations that we've performed in our capitalization rate study. The top of page 4, we quote from the appraisal of real estate, and the first concept is the basis of income producing real estate is the future income it will produce. Historical data is relevant only insofar as it helps interpret current market anticipations, and the reason for the importance of that will come clear very shortly in my comments. Paragraph number 2, that entirely goes to the principle of anticipation. Which is essentially what you anticipate the property in the future is going to be able to generate when you're calculating a stabilized NOI and doing your financial modeling. And the third paragraph states what I'm going to be suggesting this afternoon. Historical income and current income are significant, but the ultimate concern is the future. Current income is a good starting point, but the direction and projected pattern of income changes are critical, and that's again going to become clear in my comments as we move through this. Could I ask the board members and Mr. Assessor, please, to turn to page 7 briefly? One of the themes that you'll hear, I'm sure from myself and my colleagues and other folks in the industry relates to the impact of the substantial and very rapid increase in interest rates between basically the start of 2022 and the reference date. As you can see on the chart at the bottom of that page, the rates had climbed from 0.5% up to roughly 4.5% in a very, very short period of time. And ultimately, then if you look at, and I'll go to pages 8 and 9, Page 8 at the top indicates the bonds, so the 5 and 10-year bonds and the mortgage rates that were predictably following those bond rates. And of course, mortgage rates had, as a result of the Bank of Canada's decisions to quickly increase the base rate, all of those rates you see on that chart had risen significantly by the reference date. And even more interestingly, on page 9, at the top of page 9, you'll see the chart with the capitalization rates and the 10-year Government of Canada bond yield. And again, predictably, the cap rates are typically following the bond yields. Usually there is a lag. In fact, there's virtually always a lag, but certainly the trend with the higher interest rates would, we suggest, very much mean that when you're looking at future income, when you're looking at stabilizing the income, but also the rate of return that one's expecting, that the required capitalization rate as a return on investment is going to increase because of those very different conditions in financial conditions as of the reference date with the much higher rates. So with that said, then if we turn briefly to page 12, and I will say this down again, if Mr. Assessor and the board members might make a note of this in their records for the purposes of the hearing this afternoon. On the top part of that chart, the third property is 738 St. Mary's Road. And we've been made aware, and the assessor correctly pointed out an error in our calculations not at the hearing today, but at a separate hearing. So we're asking that property be removed. And we're redacting that property in our analysis for those reasons. So what we're left with then is a total of 5 comparables for our capitalization rate analysis, ranging from a low of 5.42% for the property on Hendon, up to a high of 7.11% for the transaction involving 677 Maryland. And all of the supporting data, what follows on pages 13 through 21, actually 13 through 23, is how we stabilized the net operating income relating to these properties. And behind that is our details of each of the individual properties, each of the individual, where we had the data, all the individual data that went into the stabilization that you see on pages 13 through 23. In the case of 2390 McPhillips, and I'd mentioned, Mr. Chairman, earlier, this concept of the principle of anticipation and the financial modeling where it's anticipated that the NOI would change significantly. And in our submission for 2393 or 2390 McPhillips, we are very much suggesting that the market or the rental rates that were in effect for that property were well below market. And in our stabilization, we have included based on the market evidence and specifically the CMHC evidence, we've applied higher rents that would indicate a much different cap rate, and that is our analysis, the summary on page 12, and then get to the basic details on pages 21 and 22. That would indicate that the expectation and the modeling for that property would be based on a potential gross market rent of $1,649,000. Based on those, based on the market data, and not the $1,445,000 that was the actual rent in place in 2019. So this gets to, as I say, the principle of anticipation and what the expectation was of the purchaser at the time. The statistical analysis or the stats that we used are on page 22, which show from CMHC the various rents that would be expected to be achieved for a property of that vintage, and it's a newer property. So for all of those reasons, and taking a look at our range, in the case of the subject, so now I'm going to go back to our main submission. And if you look on page 13 of our main submission, the age bracket that the subject falls into is This is a 1965 build, and that would fall into the bracket 1946 to 69, with a range of 575 to 6.5. And in my valuation that I'm suggesting, I've used a rate at the very bottom end of that range at 5.75%. So again, I reiterate with respect to the NOI, I've amended that to agree with the assessor's NOI of 113,103 to reflect the addition of that basement suite. And applying that revised NOI with a rate of 575, I come in at a requested value of 1,967,000. Remind me, Mr. Chairman, am I presenting my rebuttal now or first having questions?
We're having questions first.
Okay. Thank you very much.
Okay, questions, Mr. Assessor.
Mr. Reimer mentioned that the principle of anticipation is the main role when you are calculating the cap rates, right?
So anticipation has to be, is a fundamental principle of it. Yes, absolutely.
Yeah. Now, if you use based on the principle of anticipation, the income base, so do we need to consider the same principle to calculate the expenses too?
Absolutely. It's a question, Mr. Assessor, of what you anticipate on a go forward for the items, all of the items, the income and expenses both. Certainly there had been, the expenses, if one's anticipating a substantial increase in the expense ratio, you would also factor that in as well, 100%.
Okay. I think for now, that's all my questions. Thank you.
Okay, questions, Ms. Warren.
I do not right now, sir. Thank you.
Okay, Mr. Robson.
I also do not right now. Thank you.
Okay, just on your cap rate, so then those properties you presented are the only ones that you've used in deriving your cap rate?
Those are the ones that we're using in our analysis. Yep.
Okay, wouldn't the city then have a broader range of properties for which they've developed cap rates?
Well, I mean, in terms of, I have a couple of comments on that. In terms of the access to the data that the city has, I have no doubt they have more data available to them. The cap rates that we've presented, Mr. Chairman, are where we have to have some data on which to base the cap rate, and it's these properties where we had that data. As far as I do note with interest, when you raise the question of, sort of the range that the city has, I do note with interest that if you recall Mr. Assessor's presentation and the 20th percentile of the modeled rates, and that's just for reference on his page 6. His 20th percentile is 4.75%, but several of the rates calculated for the specific properties on his page 5 are well below that. So I can't comment on what other data I might have had available, but I can only comment on what I see on the face of the record.
Okay, thank you. So I have no more questions, and now you can present your rebuttal then.
Okay, so if I might,
Let me just repeat that. Sorry, Mr. Chair and Mr. Applicant. Okay.
thank you.
First.
Just waiting for it to be put into our folder.
Okay, it should have just uploaded, so you might have to refresh. As for the assessor, it has left my inbox, so should be momentarily to you.
Okay, that's Altus rebuttal to city,
Yep, that'd be.
and hence it's refreshed a few seconds ago.
I receive it.
Sorry, Mr. Assessor, you have not seen it yet?
No, I receive it.
You did. Sorry.
Yeah, I did.
Mr. Chairman, let me know when I can proceed.
Yeah, you can proceed now. Yep.
Okay, thanks very much. So in the rebuttal, briefly to page 2, please. So the statement that we make at the top is that the department's indicated range for, and this is now relating to the specific properties on the assessor's page 5, are between 3.46 and 574. Recall, Mr. Chairman, that I had raised the question with the assessors to contrast between some of those rates and the 4.5% GIC, which is a guaranteed rate of return. And I'd suggest that when you're talking about a 3.46% relative to a GIC that's fully 104 basis points higher, I'm a little skeptical of that. I'm not skeptical of the math. I'm skeptical of the of how the NOI might have been stabilized to arrive at that rate. Recall too, Mr. Chairman, I'll just make this point. I talked about the rapid rise in the interest rates and the spreads between the 10-year bond rate and the cap rates. The transactions in that chart, as you move through the transactions in 2022, it's a much different economic environment with respect to rates and capitalization rates generally from that chart. That would indicate that the environment certainly had it was more difficult as of the reference date because of those factors. If you then turn to page 4, please.
Okay.
On page 4, we make a comment concerning the property at 459 Sargent. We took some information from the MLS listing for the property, which states that the annual gross income is $101,142. And this, of course, relates to the transaction itself and the listing at that time, for an average monthly rent of $740 a month plus some a rent of $40 per stall for 5 stalls. That is then on our page 5. We have restated the indicated rate for that property using the $740 from the MLS listing, which was presented by the listing agent, and then running that through, as you see on page 5, the indicated capitalization rate would be 5.79%. Page 6, a copy of the MLS listing that speaks to those numbers that were advertised for the rental rates and the PG and the gross income are listed on that page 5. For Hendon Avenue, and this is now on page 7. Mr. Assessor was very, very forthright. He said that the stabilization that the department put, the way they stabilized the NOI, I was looking at historical information, but the concern we have with Hendon is that, and I had mentioned this briefly in my question, the residential tenancies branch, on effective June 1st, 2021, had ordered increases in the rentals there, and the purchaser had indicated a gross potential rate of $712,000 for 2021. And then, so when taking that into account, and I'd suggest, Mr. Chairman, very strongly that certainly the purchaser, with the transaction happening in June, and the application at the RTB board well in progress, that they would have been considering that in their due diligence. So on page 8 of our rebuttal is our calculation of a rate of 5.42% using the higher average rent of $1,006 per suite based on those RTB orders. The materials relating to that RTB decision are located at pages 9 through 14. Then turning briefly, if we could, to page 23. So recall, Mr. Chairman, I'd asked Mr. Assessor about the transaction that the department's got in their materials for 677 Maryland. The sale that I referred to was a March 1st, 2023 sale with a sale price reduced from 2.4 million, which is the transaction the department's got in 2020, to 2 million, pardon me, 2,176,000. That was the sale price in 2023. So it went down by roughly 225,000. If you use that more recent sale in the cap, and we use that more recent sale in our own study with a cap rate of 7.11%. If we use the city's NOI as calculated in the 23 sale price, the rate would be 6.2%. So we do have concerns. I don't certainly question Mr. Assessor's statement that they didn't have the full information, but with the drop by 225,000 in that sale price in 2023 from the 2020, we're using that more updated information and updated sale price to calculate our cap. So 2390 McPhillips, this is the one that I've suggested to the board and to Mr. Assessor that the rents in place at the time of the transaction were well below market, and we've applied a market rate based on the CMHC statistics, resulting in a capitalization rate of 5.59% as shown in our study. 700 St. Mary's, for the reasons I've indicated, you can disregard that. Moving then to page 25, for 32 Arden, the property was renovated after purchase and was suggesting that indicated an intent to renovate. And was also an older sale in 2019. For the board's reference, pages 29 through the end of the rebuttal submission at page 35, there's a copy of the municipal board decision that speaks to the caution in applying or in using properties that were purchased with the intent to renovate as valid for capitalization rate comparables. And the reason for that, of course, being the financial modeling. If you've got an intent to renovate in your financial modeling going into the purchase is a much different potential gross rent, which that's the entire reason, and that's how some of these properties are purchased. The renovated asset will achieve significantly different potential gross rents than the pre-renovated asset. That directly impacts your entire modeling and your calculation of the NOI, which in turn impacts the cap rate. So we provide that for the board's reference in this case. Subject to any questions, those are my comments in rebuttal. Thank you.
Any questions, Mr. Assessor?
No question. Actually, I have comments, so maybe no questions. I will do that comments on my.
Okay. Questions on the rebuttal, Mr. Robson?
No, I do not have any questions.
Ms. Warhan?
None, Mr. Chair. Thank you.
Okay, thank you. So then, Mr. Assessor, you said you had rebuttal. Do we have that in our package as yet?
Yes, it should be uploaded to the SharePoint, and I just sent it on my email. Let me see. Should have left my inbox, so Mr. Applicant, you should get it shortly.
All right, I will keep hitting send receive until I see it.
Sounds good. And panel, you're able to find it okay? Should be just A&T rebuttal is the name of it.
Oh, there it is. Okay. If it
Yes,
was a
thank you.
if it was a bear, it would have bit me, as my mother would always say. Okay. Do you
Sorry,
have
Mr.
it?
Oh, now I do. Yes, now I have it. Thank you.
Okay. So you can proceed, Mr. Assessor, then.
Okay, thank you, Mr. Chair. You can see on the first page the information about Altus cap rates. So we actually mentioned 345 Talbot, 677 Maryland, 738 Maryland, St. Mary's, and 100 Maryland, and to 2390 McPhillips Street. So each page we have our comments on that. Page 2, you can see 345 Talbot Avenue. So in here, the only 1 year of income, hire, and expense information is insufficient for determine the capitalization rates. That's our comments on that, and also they haven't been reporting income and expense mailer for the city regularly. So page 4, you can see 677 Maryland Street. So in here you can the bottom remarks, you can see the consistent decline in the sale price, sold 2.6 million in 2014 2.4 million in 2020, the income statement with the year end of March 2022 was the most recent income statement that purchaser was given by the vendor. Prior to the statement were partial year only. So basically 1 year of income and expense information is insufficient. That's our suggestion for that. And also I have to mention here, we found out the unit 14 of 32 was vacant because of they haven't used the sales for the 40. I have to say that we found out unit 14 of 32 was vacant. So we don't know when the alters calculate how they calculate the income. Are they calculated based on that 14 unit or 32 units? So that's our concern there. And also 738 St. Mary's Road. That's the one Mr. Reimer said they are going to remove. But I have to mention one thing. Actually they had a mistake there. So that means realty tax should be 15,674. When correcting that one, the cap rates come out 4.58. That's near to GIC rate. So that's the thing there. And 738 St. Mary's Road financial there in the next page. And 100 Maryland Estate, they calculate with not actual data. So 2390 McPhillips Street. Altus calculation average rent levels are inconsistent with the rents reported in the prior year. So because of that, we think that calculation is not right. So that's my rebuttal. That's the end of my rebuttal. Thanks.
Questions, Mr. Reimer?
Well, I guess just a couple of brief questions, Mr. Assessor. So, I mean, you're saying that 1 year isn't enough, but 1 year data is mathematically, again, you can still calculate the capitalization rate based on the 1 year data as opposed to it being completely unusable. Would you agree with that?
Yes, you are right. We can use 1 year data, but if we are compare with the 3 years data, that's a more reliable. I can comment on that.
Certainly, the more, and I will agree with you, the more data you have, the better it is. But I guess what I'm suggesting to you, Mr. Assessor, is the term unusable is used, and I don't. We can agree at least that if you got 1 year's data, notwithstanding that it's not as good as 3, you can still calculate the cap rate. Okay.
Sorry, sorry to use that word, but yeah, I mean, it's more. I mean, when we are using more information, that means that's more reliable. I would say that way.
Okay. There is another comment you had, and I'm going to get to, I thought it was Maryland. Maybe, you know what, was it 345 Talbot, where there was one of the which property was it where you were unsure, the apartment's not sure about how we got to our rental, our potential gross rent. I thought it was
that's
Maryland.
677 Maryland.
Okay,
yeah.
Okay, exactly. So I would, and Mr. Chairman, I'll just ask the question, but ask the board and Mr. Assessor to refer back if need be. You do understand for 677 Maryland in our cap rate, and you need not turn there, but in our capitalization rate study at page 68, we actually have the rent roll submitted in our submission. And what we did, to be clear, Mr. Assessor, is we took the average rent from that rent roll at $813 a month per suite, and that's how we arrived at our potential market gross rent of $312, $100 or $192. Were you aware of that as well, or?
Right now, I know.
Oh, okay, fair enough. In the case of McPhillips, you know what? Actually, Mr. Chairman, there's no point in rehashing that. I would appreciate an opportunity just to speak in summation one time with this property in response to the rebuttal and some of the other materials. But those would be my questions. Thank you.
Okay, thank you. Questions on the city's rebuttal, Ms. Wurhan.
I do not, Mr. Chair. Thank you.
Mr. Robson.
Just to confirm, you did agree with the applicant that sale 1 to 3, we can use that, or you agree that you can use that data after just 1 year of history?
It's
just not as strong data?
Yeah, no, I mean, I didn't agree, but I mean, it's more reliable if we have like more information, right? Based on that,
right,
our information have like more information. So because of that, I will say our capitalization rates are the how I say more reliable. And yep.
Okay, thank you.
All right, and I have no questions. So summation, Mr. Assessor.
No thanks.
Okay, Mr. Reimer.
Thanks, Mr. Chairman. I'll be very brief. So as you can probably glean from this hearing, the major issue in all of these appeals is going to be the capitalization rate. While I don't disagree, absolutely don't disagree with Mr. Assessor that to have 3 years of data to indicate or to calculate a cap rate is better than 1 year. The term unusable, I just fundamentally disagree. Where you've got the 1 year and where it's from a reliable source, it does provide an indication. And what I'd also point out, Mr. Chairman, is that if you look at the data for which, or sorry, I should say the data that was used for those properties where 1 year's information was available, when you look at the rents and when you look at the expense ratios, the numbers certainly are very consistent with what you're going to see this afternoon, particularly in terms of the expense ratios and to a large extent the rent. So if you had I give this as an example, if you had a property where you're using 1 year modeling and the expense ratio was either extremely high, say 75, 80%, or very low, that would indicate certainly that it's an unreliable measure. That's not the case with these properties. When you go through the materials and the workups we've done, the rents and the expense ratios certainly compare very, very well with the rents and the expense ratios that are going to be presented this afternoon. So for all of those reasons, I am asking for a rate of 5.75% in this case for the reasons set forth in this study, and ask the board to order accordingly. Thank you.
Okay, thank you. So let's move on to 304 Stradbrook. And let me just open the correct files. Okay, so Mr. Assessor on 304 Stradbrook.
Thank you, Mr. Chair. File number 24-1462, roll number 12031698500, roll year 2025, reference date April 1st, 2023, assess value 2,190,000, number of building 1, two-story building, actual build year 1964, number of suite 22, outdoor parking 12, page 2, request for income information. You can see subject property sales history, and page 3 you can see the location of the property and aerial picture of the property. And page 4, income value summary. Average monthly rent per unit 854. Gross potential rent comes at 225,617. Vacancy rate 3.2%. Effective gross income comes at 218,397. Expense ratio 49.37%. Net operating income comes at 110,574. We have used capitalization rate 5.05, and estimated market value comes at 2,190,000. Page 5, you can see the rent comparables. So subject the model rent supported by rent comparables. I'm not going to go with the each comparables. So page 6, capitalization rate, and those are model driven capitalization rate. And you can see the multifamily capitalization rate below 20th and 18th percentile, 4.75 to the to 20th percentile 4.75 and 80th percentile 5.45. And capitalization rate evidence, as I said, those following is a sample of the actual sales that took place during the reference period. The purpose of showing these individual capitalization rate is to illustrate the accuracy of the model and substantiate the model driven capitalization rate. They are not meant to be the comparable specific to the subject property. So model cap rate supported by the above capitalization rate, especially 32 Arden Street. Page 8, municipal assessment at exit. Page 9, exterior and interior picture of the building. It's not bad. It's a average building there. Page 12, I have done stabilization here. Before that, you can see 2021, they have like 60% expense ratio there. And because they have higher R&M for that year, I believe normally if it is R&M higher, that means they might do renovation there. So basically, our NOI supported the stabilized NOI. Page 13 to 21, income and expense information. I believe 2,190,000 is fair value for the property. This concludes my presentation. Thank you.
Right. Questions, Mr. Reimer?
Thanks, Mr. Chairman. This is going to proceed fairly swiftly now from here on in. Mr. Assessor, could we turn briefly to your page 4, please? And so just to be clear, on page 4, the valuation that the department's got, this is entirely model driven from top to bottom, including cap rate, correct?
That's right.
Mr. Chairman, that's my only question. Ask that the previous questions and answers given on cap rate be carried forward. Thank you.
Okay. Mr. Robson, questions?
No questions at this time, Mr. Chair.
Ms. Warren?
None right now. Thank you.
Okay, Mr. Reimer, your presentation, please.
Thanks, Mr. Chairman. Could I ask the board members and Mr. Assessor please turn to page 15? And recall, Mr. Chairman, that the original and effective age of this property is 1964. So in that context, as you see on page 15, the NOI we're calculating in this case is actually comes out roughly $7,000 or $6,500 higher than what the department has modeled. So we are somewhat higher, but we are asking for the capitalization rate of 5.75% to be applied. And again, for the same reasons I provided previously with our capitalization rate study and the rebuttal evidence, the bracketing for the subject is between the 1946 to 1969, the subject being 1964, I believe I said it was. Yeah, 1964. So we're going at the low end of that range, Mr. Chairman, at 5.75%, and ask for the assessment to be reduced to $2,035,000. Thank you.
Okay, questions, Mr. Assessor?
No question this time.
Okay, Ms. Werhun.
None, thank you.
Mr. Robson.
None as well.
Okay. Thank you. We will do one more property and have a quick break. So 311 Stradbrook. Okay, let me again get the proper files. Okay, Mr. Assessor, on 311 Stradbrook.
Mr. Chair, file number 24-1483, roll number 12031798100, 311 Stradbrook Avenue, roll year 2025, reference date April 1st, 2023, assessed value 2,251,000, classification 20 residential, liability taxable, number of building 1, that's a 2-story building, actual build year 1966, no effective year build add, number of suite 22, outdoor parking 14, and next page, page 2, you can see the location and aerial view of the property. Page 3, request for income information. Page also you can see the subject property sales history there. Page 4, income value summary. Average monthly rent per unit 863. Gross potential rent comes at 227,885. Vacancy rate 3.2. Effective gross income 220,593. Expense ratio 48.97%. Net operating income comes at 112,569. We have used 5% capitalization rate. So based on that, the market value comes at 2,251,000. And page 5, you can see the comparable rents. So the model rents supported by the market rents. Page 6, capitalization rate, you can see those are model driven capitalization rate, and I'm not going to give the like more read all of them. So page 7, capitalization rate evidence sales. So model cap rates 5% supported by capitalization rate evidence, especially 32 Arden Avenue. Page 8, Municipal Assessment Act excerpt. Page 9, you can see the exterior picture and interior picture of the building. And page 10, 11, and 12, that's a well-maintained building. So, page 13, you can see income and expense information. And page 14, you can see their net operating income for 2022 that supported our net operating income. And page 15, also the income and expense information. Page 17, that's the 2021 income and expense information, and that's NOI 123,665 supported our model NOI. And in 2020, they have submitted the paper, but no information in the paper. So I believe 2,251,000 is fair value for the property. This concludes my presentation. Thank you.
Okay, questions, Mr. Rammer?
Thanks, Mr. Chairman. Just a couple. Mr. Assessor, very briefly on your page 7. And now you had briefly mentioned that you thought of those comparables, 32 Arden, you thought was an appropriate or the most comparable. Did I hear that correctly?
That's right.
Okay, now with 32 Arden though, the original year built is 1969, but the effective age on that property is 1985. Could we agree on that?
Yeah, that's right.
And in this case, the effective age and the original age are both 1966, correct? Thank you. And then briefly on your page 4, and again, I know the answer, but for the purpose of the record, this is valuation on page 4 is entirely model driven from top to bottom, including cap rate, right?
Yes, that's right.
Thank you. Mr. Chairman, those are my questions.
Okay, Ms. Werhan, questions?
None, thank you.
Mr. Robson?
None, thank you.
Okay, Mr. Rammer, your presentation.
Page 15, please. So again, while we're looking at page 15 in our submission, I will tell the board that the difference in the calculation of the net operating income is very, very slim between the department's model driven of 112,569 in our own calculation at 110,113. Obviously, this is always within a reasonable tolerance. We're very close, so I'll leave it to the board to decide whether the 112,000 or the 110,000 might be appropriate. The issue in this case, of course, is cap rate, and with the 1966 original and effective age, and the brackets that we have in the previous page, I'm using the 5.75%, which is at the very lowest end of that bracket for the purposes of my valuation, and therefore request a revised value of 1,915,000. Thank you.
Okay, questions, Mr. Assessor?
No question. Thank you.
Okay, Mr. Robson?
No questions as well.
Ms. Werhan?
No questions, Mr. Chair. Thank you.
Okay, let's take a break to 2:20, I guess 12-minute break, and then we'll come back then. Okay, thank you. Welcome back. We will resume with 324 Stradbrook. So, Mr. Assessor, you can begin.
Thank you, Mr. Chair. File number 242239. Roll number 12031693500, 324 Stradbrook Avenue. Roll year 2025. Reference date April 1st, 2023. Assess value 2,985,000. Classification 20 residential. Liability taxable. This is subsidized housing. So normally this kind of property we consider as a below average property to account for the nature of the operation. So page 2, you can see the location and aerial picture of the property. Page 3, request for income information. No sales, sales for the property. Page 4, income value summary. Average rent per month, $926. Gross potential rent, 3,000. 238. Vacancy rate 3.2. Effective gross income comes out 290,630. Expense ratio 45.06. Net operating income comes at 159,672. We have used 5.35 capitalization rate. Estimated market value comes at 2,985,000. And page 5, you can see the rent comparables. The rent comparables supported the market, the model rent. And page 6, you can see the CMHC average rent calculation. And on page 7, the model rent as a percentage of the market rent, it's is 91.66%. And page 8, CMHC chart, and page 9, capitalization rate rates. This is model driven. I'm not going to explain everything because now it's with the board. Page 10, capitalization rate evidence. The model capitalization rate supported by the those capitalization rate evidence. And page 11, Municipal Assessment Act excerpt. Page 12, exterior picture of the building. And page 13, also the exterior pictures. And page 14, 15, up to page 20, income and expense information. I believe 2,985,000 is fair value for the property. This concludes my presentation. Thank you.
Okay, questions, Mr. Reimer?
Again, just one, Mr. Chairman, thank you. So, Mr. Assessor, you need not turn there, but just to confirm, the value of 2,985,000 shown on your page 4 is model driven right from top to bottom, correct?
Yes, that's right.
Thanks, Mr. Chairman. Again, same request, questions asked and answered on CAP, and leave it at that. Thank you.
Okay. Mr. Robson, questions?
No, no questions at this time, Mr. Chair.
Ms. Warhun?
None, Mr. Chair, thank you.
Okay, Mr. Reimer, your presentation then.
Page 16, please.
Okay.
So on page 16, Mr. Chair, the primary issue, pardon me, in this case relates to CAP, but we also have a slightly different NOI. In this case, we're not suggesting, as you can see at the top of page 16, obviously the rents in place, they are, as Mr. Assessor had indicated, it's subsidized housing, and we're not using that in any ways reflecting market. We've accepted the department's calculation of the market potential gross rent of 300,238, market vacancy of 3.2. As you can see, though, we do differ somewhat on the expenses at 147,855. So our final NOI comes in at 152,646, slightly lower than the department's at 159. So we're about $7,000 apart. Not a significant difference, but a difference. We are, though, suggesting 6.25% capitalization rate in this case to reflect the elevated risk relating to the subject and the the social housing, the lack of amenities and such. So in this case, with those, and I'm referring back to briefly to our page 14, the rate we're suggesting is 6.25% with a 0.25% premium for the negative factors such as the smaller suite size, the limited parking, and it's all of course 1 bedrooms. There's no 2 bedrooms there, and the durability and quality of income being higher risk because it's subsidized housing. So for all those reasons, we're suggesting 6.25, and the requested value this afternoon is $2,442,000. Thank you.
Okay, questions, Mr. Assessor?
I have one question. So we consider as a below average property. So to account the nature of that means the risk and everything to account. So based on that, do we need to again adjust on that risk onto the cap rate?
Pardon me. I think I understand, Mr. Assessor, what you're saying. What you're suggesting is the department's potential gross rent of $300,238 in the department's mind is accounting for the risk, and therefore you don't need to reflect it again in cap rate. Am I understanding that right?
Yeah, that's right.
Okay. So my response would be this: if you look at if I could ask Mr. Assessor, could you go to the top of our page 16 again, please? So at the top of page 16, what we've done, the actual, and I think everybody here understands that the actual rents are less than half of what we're actually applying. So I appreciate the department's position that the risk is already reflected in there. I don't quite see it that way because again, the rents that the potential gross rent we're applying is double, more than double that that's in place. So that goes to the durability of the income stream. So I guess my quick answer then, Mr. Assessor, would be I don't agree that the $300,000 in potential gross rent would fully account for the risk given the huge gap, and it's more than a double of the actual income, and therefore I believe the 6.25 rate with that 25 basis point premium would still be justified.
Okay, thank you.
Was that all your questions?
Yeah, that's all. Thanks.
Okay, Mr. Robson, questions?
No, Mr. Chair, I do not have any.
Ms. Werhun?
None, Mr. Chair, thank you.
Okay, thank you. Let's continue on our journey down Stradbrook, or up Stradbrook, as the case may be, to 330 Stradbrook. 320 Stradbrook, rather. Sorry. Let me just open the correct files. Okay, Mr. Assessor, on 320 Stradbrook.
Thank you, Mr. Chair. File number 24-2159, roll number 12031695000, 320 Stradbroke Avenue. Roll year 2025, reference date April 1st, 2023, assess value 2,842,000, classification 20 residential, liability taxable, number of building 1, 3-story building, actual build year 2015, number of suite 15, outdoor parking 11. Page 2, location and aerial picture of the building. Page 3, request for income and income information, subject sales history. And page 4, income value summary. Average monthly rent per unit, 1,434. Pardon me. Gross potential rent, 258,199. Vacancy rate 3.2. Effective gross income 249,937. Expense ratio 4.7. Sorry, 47.12. Net operating income comes at 132,167. We have used a 4.65 capitalization rate. So based on that, estimated market value comes at 2,842,000. And page 5, you can see rent comparables. Model rent supported by comparable rents. Page 6, capitalization rates. This is model driven capitalization rate. I'm not going to read the whole thing because now panel is familiar with this. And page 7, capitalization rate evidence. The model capitalization rate supported by the capitalization rate evidence. The 241 Young Street is the most relevant one, I believe. And page 8, Municipal Assessment Act excerpt. Page 9, picture of the building. This is a modern building. You can see inside of the building and a picture of the building. And page 12 and page 13, you can see the sketch and inside how they build it. And page 14, you can see the income and expense information, and I'll mention there. The bottom of the page, advertising, they have mentioned just $10 there. And page 16 also income and expense information. And page 17 also advertising, they mention 129. And page 18, the actual income information. And page 19 and up to page 23, and that's the 2020 income and expense information. So in there they have 514 for the advertising. So page the last page, I actually try to stabilize the information. You can see in here the rent, the effective gross rent like went down from the 2020 to 2022. So I'm not 100% sure. You can see the advertising, they don't have, like, they drop their advertising. So I believe maybe that's the reason. And also that means they are poorly managed this property. So like if they poorly manage, do we need to discount them? That means do we need to give the reduction? So I believe the 2,842,000 is fair value for the property. So this concludes my presentation. Thank you.
Okay, questions, Mr. Reimer?
Thanks, Mr. Chairman. Again, Mr. Assessor, with reference to your page 4, this is an entirely model-driven valuation from top to bottom, including cap rate, correct?
That's right.
Okay. Mr. Chairman, those are my questions. Thank you.
Okay, thank you. Ms. Werhan, questions?
Yes, sir. Just on the cap rate, I'm sorry if I didn't hear it properly. Which one of the properties on your page 7 did you say best reflected how you came up with the cap rate for the subject property?
Yeah, basically, I mean, these are, we can't compare directly to the property, but I believe 241 Young Street is the best one to select because we don't have 2015 sales here. I mean, the build year here. We just have we have one 2015 sale, but it's 19 units, 90. That means that's a higher unit, right? But our subject property have 15 units. So based on the unit, I believe 241 yuan is the most relevant one.
Okay, I understand and thank you, sir. But the 4.21% cap rate on the Yonge Street that you're using is, and compared to what you're presenting here at 4.65, I'm still not understanding how you came up with your 4.65.
That's a model driven one, right?
I understand.
Yeah. So I'll
because sorry to interrupt. Because
yeah, sure, go ahead.
Yeah, because if you go on the capitalization rates, again, where did the 4.65 fit in here? I'm trying to see where you would have came up with that on this chart.
We mentioned here, this is try to give you an idea. Our capitalization rate is the following is sample of actual sales took place during the period. The purpose of showing these individual capitalization rate is to illustrate the accuracy of the model and substantiate the model driven capitalization rate. So basically we can't directly compare with the subject property because that's the model driven, right? So I try to give the ballpark using the unit count. That's what I meant.
Okay, and are you basing it on a multifamily low rise? Or what are you basing it on when it comes to the other capitalization rates for Colliers and the city of Winnipeg? Which are you under the low rise A?
Yeah, I believe this is multifamily low rise.
Low rise A or B, sir?
The quality of the building. This is the story. As information here, I think B, not the A, because this is look like wood construction.
Okay. So yeah, so then you're below the 20th percentile then.
Yeah.
Okay, yeah. Thank you. That's all my questions, Mr. Chair.
Okay, Mr. Robson.
No, my question was asked and answered. Thank you.
Okay, so Mr. Reimer, you can begin then.
Thanks, Mr. Chairman. I'm going to refer briefly back to Mr. Assessor's page 7 because the questions that have been raised, I was going to just comment on that. My suggestion, and you look at the chart on page 7, appreciate that Mr. Assessor's looked at the suite count, but I'm suggesting to you a 1960 build at 241 isn't necessarily the best comparable, but and none of them fit squarely. But if anything, if you go down to the second last row of 32 Arden, it's a 2-story property with 23 suites, a few more than the subject, but it has, if you recall, significantly updated effective age, which indicates substantial renovations, and that was at 5.02%. So for whatever it's worth, I'd suggest, if anything, that would provide a more reasonable baseline than Yonge Street. If I could ask the board members and Mr. Assessor to turn to our page 15. So again, Mr. Chairman, this is another case where our NOI calculation, we're getting there through different means, but the NOIs of the respective NOIs of the department and ourselves are very, very close. We come in at an NOI of 129,591 relative to the assessor's NOI, model-driven NOI of 132. So I leave it to the board to decide which of those two NOIs might be appropriate, but obviously very close. We are, though, suggesting an increase in the capitalization rate based on this new build, 2015 at 5% based on the information in our study. And the request is framed around that 5%, resulting in a value of $2,592,000. Thank you.
Okay, questions, Mr. Assessor?
One question. So this is new build, right? Normally,
2015, yes.
Yes. Normally, if it is new build, the capitalization rate should be lower, right?
Absolutely, yes.
So, yeah, that's all my question.
Yeah, I've used the lowest rate, just to be clear, Mr. Chairman, in answer to Mr. Assessor's question. I've used the 5%, which for the reasons we present in our brief, the chart again, the summary chart's located on page 13, and the lowest end of the range for the new quality, or the new builds, I should say, is 5.00%, and that's what I've applied in this case.
Okay, that's all my question. Thank you.
Okay, Mr. Robson, questions?
No, I'm good once again with no questions. Thank you.
Okay, Ms. Warren?
I do not, Mr. Chair. Thank you.
All right. And I have no questions, so let's move to 333 Stradbrook. I tried to get there last time, but I was ahead of my time. Again, let me open the files. Okay, Mr. Assessor, on 333 Stradbrook.
Thank you, Mr. Chair. 24-3042, roll number 12031796100, 333 Stradbrook Avenue, roll year 2025, reference date April 1st, 2023, assess value 5,663,000, classification 20 residential, liability taxable. Number of building 1, this is 6-story building. Actual build year 1963, no effective year build. Number of seats 41, outdoor parking 41, and page 2 request for income information and subject property sales history. Page 3, location and aerial picture of the property. Page 4, income value summary. Average monthly rent per unit 1,185. Gross potential rent 583,261. Vacancy rate 3.2%. Effective gross income 564,597. Expense ratio 46.34. Net operating income comes at 302,963. Capitalization rate we have used a 5.35 capitalization rate. Based on that, estimated market value comes at 5,663,000. And page 5, you can see the rent comparable. The model rent supported by those comparables rent. Page 6, capitalization rates. Those are model-driven capitalization rate. And page 7, you can see the capitalization rate evidence. The following is sample of actual sales that took place during the reference period. The purpose of showing this capitalization rate is to illustrate the accuracy of the model and substantiate the model-driven capitalization rate. They are not meant to be comparable to specific to the subject property. I believe model cap rate 5.35 supported by the those sales. So page 8, Municipal Assessment Act excerpt. Page 9, picture of the building, exterior picture of the building. Page 10, 11 is interior picture of the building. It's actually nice apartment inside. Page 12, I stabilize the income and expense information. You can see there are vacancies, not market vacancy, it's a higher vacancy rate they have. So I use 3.2 market vacancy. And also you can see maintenance and repair. They have higher maintenance and repair. That means they have higher vacancy, and higher maintenance and repair means they might do they are doing some renovation. So that means maybe they are doing one or I mean I don't know how many, like maybe few units per year. Then in that way they can secure the income, like a good income, and they can do the renovation too. So I believe because of that they have higher vacancy. So page 13, income and expense information, up to page 21, income and expense information. And I believe 5,663,000 is fair value for the property. This concludes my presentation. Thank you.
Okay, questions, Mr. Raymer?
Thanks, Mr. Chairman. I got a couple on this one. Mr. Assessor, just very briefly on your page 4, and again, just to be clear, the value shown on page 4 from top to bottom, including the cap of 5.35%, that is entirely model driven, correct?
Yes.
Okay, so let's go to your page 12 for a few minutes, please, if we might. So if I'm understanding correctly on page 12, what you've presented on this page, you've applied the, in terms of the stabilized column, you've got the value of 551,626, and that is then, that's based on the 2022 actual potential rent, correct?
Yes, correct.
Okay, but then on the next line, you've defaulted, rather than look at actuals for the vacancy, you've defaulted to a lower vacancy rate. Okay, the lower vacancy rate, and without reference to the actual vacancies in that 3-year period.
No, that's a market vacancy rate.
I understand I understand what you're presenting, but you would agree that the actual vacancy rate was between 5.89% and 8.03% in that 3-year period, correct?
Yes, but yeah, that's right. But we can see the maintenance and repair is too high for the building. So that means they are doing renovation maybe few minutes for the year. That's why that's my opinion. Anyway.
Certainly. So let's talk about that for a second, though, because I believe, Mr. Assessor, there's a bit of an inconsistency there in what you presented. So we can agree for 2022, and now I'm focusing on the maintenance and repairs. In 2022, the maintenance repairs were substantially higher, 164,881, higher than by quite a margin than the other 2 years. We can agree on that?
Yeah, that's right.
But the vacancy, if you go back up, the vacancy rate had actually dropped from 8.03% to 5.89% between 2020 and 2022.
Yeah, that's right.
So notwithstanding that the expenses reported had increased significantly, the vacancy rate had in fact dropped significantly as well over that 3-year period, correct?
We can say that way, but we can see in the other way too.
I don't understand what the other way is, though, Mr. Assessor, because the expense has increased by fully $50,000 between 2020 and 2022, but at the same time, the vacancy rate has gone down. So there's actually an inverse correlation between those expenses that are presented there and the vacancy rate.
Yeah, because I said that we can see the market vacancy, right? It's lower than the 5.89. So because of that, I can't believe this is the market vacancy. That's the reason I am saying that.
Okay, but just to clarify, the way I understood your logic, and correct me if I'm wrong, Mr. Assessor, but I believe you said the reason, in your opinion, and your theory of it, the reason the vacancy is so high is because of the renovations, substantial renovations and such, where some units would be essentially off the market for a little longer period of time because of the renovations.
Yeah. Okay.
That, though,
yeah.
You know what I mean? So that, though,
yeah,
would be
I got you.
Okay.
Yeah. So basically, like we can say this way: in maybe 2020, they have done 3 units. They have done the 3 units. In 2021, they might done 1 unit. So then the vacancy dropped, and maybe 2023, like vice versa, that unit number may be changed because of that. That's my logic, but I, I mean, that's why I suggest that.
All right. Thanks, Mr. Chairman. Those are my questions.
Okay. Questions, Mr. Robson?
Just one. When looking at your cap rate evidence, do you find all your comparables are still fair?
Sorry, can you repeat that?
Sorry,
again?
I'll repeat the question. I looked at your 11 comparables, and the average cap rate is 4.68. So I'm just kind of confused as to how you use that in coming up with your 5.35% cap rate.
Actually, these are not the direct comparables. These are just like show the our cap rates. The model-driven cap rates is between, I mean, accuracy, model-driven cap rates, accuracy, and the accuracy. So basically, we can directly compare this one with the model-driven cap rate, because I'm not sure how the model-driven cap rate is calculated. So this is kind of ballpark. So
okay,
yeah. Is that answer your question, or?
Yeah, that's good for now. Thank you.
Hey, Ms. Warren.
Yeah, I did have an issue with the cap rate also, but I would just be repeating what Mr. Robson was asking. But so I'll just say no for now. Thank you.
Okay, thank you. So, Mr. Ramey, you can begin your presentation.
Page 15, please.
Okay.
So on page 15, actually, in this particular case, we are arriving at a significantly different NOI than the model-driven NOI that Mr. Assessor presented. It starts at the top. Our potential market gross rent is $555, call it, versus the assessor's $583. Then moving down, our effective gross income is $543 relative to the department's $564. I am applying a 7.2% vacancy, which reflects the 3-year average. And recall, Mr. Chairman, the vacancy had been declining, so we're applying the average, but recognizing that as of 2022, it was actually down to 5.8%. I do, though, think based on that 3-year average, there is merit to increasing the vacancy allowance in this particular case. I had asked Mr. Assessor the questions relating to the repairs and maintenance, so I just want to draw the board's attention to that, because I'm guessing we don't have the details of the original model-driven vacant or expense allowance. But if you look at line 27, our repairs and maintenance that we've stabilized and applied in our valuation is actually $74,808. So it's not, pardon me, it's not too far off. And I'm going to go go back to the Mr. Assessor's presentation, he's got 61,500, but I'd suggest to you, Mr. Chairman, our 74,808 is based on much more detailed analysis. And if you go to just briefly to our page, so that would be page 16, you can see on that page how we arrived at our 74,808, and what we've done is based on the information received from the owner, we've taken out the item called extraordinary repairs, which we would put in the nature of capital and not repairs and maintenance. And in 2022, certainly there was a substantial amount of money that is in that category in the range of 81,500. So as you see on the bottom right-hand corner in the yellow shaded fields, we've ultimately arrived at a expense for repairs and maintenance of 74,808 based on the data there. And you can also see the various other sums that we've applied, either based on averages or based on some averages excluding years that seem to be very high. In the case of painting, counters, and electrical, we've excluded some of the higher rates, again, on the assumption, or higher expenses, I should say, on the assumption that it would be more on account of capital. So then going back to our evaluation on page 15, we have applied that stabilized lower amount of 74,808 and resulting then in a net operating income of 268,508, capitalized in this case at 5.75% based on the effective and variant age, which I believe is, I'll refer back, I believe it's 1963. So I am applying a rate at the low end of the indicated range in our submissions for that age bracket, which ranges from 5.75 to 6.5. And it results in a requested value this afternoon of 4,670,000. Thank you.
Any questions, Mr. Assessor?
No question this time. Thank you.
Okay, Ms. Burhan,
None, thank you.
Mr. Robson.
None as well.
Okay, I got a question on the vacancy rate. The vacancy has been steadily declining. Why wouldn't you use the 2022 actuals?
I think that's a fair question, Mr. Chairman. I was thinking about that when I was looking at it right now. I think you're being very fair in that question, and I would not disagree with the application of the 5.8% given the trend to lower vacancy.
So it basically results in a $3,000 increase to the NOI then.
Yeah, yes, exactly right. Yeah.
Okay. All right. Thank you. Okay. Note that down. Okay. 370 Stradbrook. And again, open the files. All right, so we're on our penultimate property of 370 Stradbrook. You can begin, Mr. Assessor.
Thank you, Mr. Chair. File number 242196. Roll number 12031681100, 370 Stradbroke Avenue. Roll year 2025. Reference date April 1st, 2023. Assessed value 4,245,000. Classification 20 residential. Liability taxable. Number of building 1. Number of story 3. Actual build year 1929. Effective build year we have there 1945. Number of suites 32. Outdoor parking 18. Page 2, you can see the location and aerial picture of the property. Page 3, request for income information, subject property sale history. And page 4, income value summary. Average monthly rent per unit 1,068, and gross potential rent comes at 410,304. Vacancy rate 3.2. Effective gross income comes at 397,174. Expense rate ratio is 44.96%. Net operating income comes at 218,605. We have used 5.15 capitalization rate. Based on that, the estimated market value comes at 4,245,000. Page 5, rent comparables. The model rent supported by the rent comparables. Page 6, capitalization rate. Those are model-driven capitalization rate. So you can, I think you're familiar with this chart. And page 7, capitalization rate evidence. These following is sample of actual sales that took place during the reference period. The purpose of showing these individual capitalization rate is to illustrate the accuracy of the model and substantiate the model-driven capitalization rate. They are not meant to be the comparable specific to the subject property. Page 8, Municipal Assessment Act excerpt. Page 9, exterior and interior picture of the building. It's look like well-maintained building. Page 12, 13, interior pictures. And page 14, you can see their net operating income supported our model net operating income. Page 16, also the net operating income for the 2021. You can see that supported our model rent, model net operating income. So I believe 4,245,000 fair value for the property. This concludes my presentation. Thank you.
Okay, questions, Mr. Reimer?
Thanks, Mr. Chairman. Again, Mr. Assessor, this is a model-driven rate from for all valuation parameters, correct?
Yes, that's right.
Thank you. Thanks, Mr. Chairman. That's my only question.
Okay, Ms. Burhan, any questions?
Nope, thank you.
Mr. Robson?
No, thank you, Mr. Chair.
Okay, this is obviously being renovated to some extent. The flooring and the appliances look new and whatnot, but I note they still have seem to have steam heating in there. Do you have any idea when the renovations were carried out?
Like, I think in 2016, one of our what was happened, I think in 2016 appeal, we find out this was renovated, and then we request to inspection, but we try to contact them and they we couldn't. So what was happened, we inspect exterior inspection, we done the exterior inspection, and then we add the effective age. That's what happened there.
Okay. So it was 2015 that the renovations were done?
I believe, yeah, because
okay.
Yeah.
All right, thank you. So, Mr. Robson, Mr. Reimer, you can begin your presentation.
Thanks, Mr. Chairman. Page 15, please.
Okay.
So we get there by very different means, but our NOI is actually $2,000 or so higher, a little less than 2,000 higher than the department's model driven. So again, Mr. Chairman, this comes down to cap. We have, for the purposes of this valuation, we've accepted the effective age and the work that was done. And so I've bracketed this in the actually in the notwithstanding the 1945 effective age that the department's got on it, I've bracketed it in the 1946 to 69 bracket at the low end of that range at 5.75%. And that results in a requested value of $3,831,000. Thank you.
Okay, questions, Mr. Assessor?
No question. Thank you.
Okay, Mr. Robson.
No questions, Mr. Chair.
All right, Ms. Werhan.
No questions, Mr. Chair. Thank you.
All right, our last property then, 361 Stradbrook. Again, I got to open the correct files. All right, Mr. Assessor, on 361 Stradbrook.
Thank you, Mr. Chair. File number 24-3579, roll number 12031782000, 381 Stradbrook Avenue, roll year 2025, reference date April 1st, 2023, assess value 2,938,000, classification 20 residential, liability taxable, number of buildings 1, number of this 3-story building, the actual build year 2016, number of, so it's 15. You can see the area, picture and location of the property in page 2, onto page 2. Page 3, request for income information, subject property sale history. Page 4, income value summary, average monthly rent per unit 1,430. Gross potential rent comes at 257,539. Vacancy rate 3.2%. Effective gross income 249,298. We have used expense ratio 45.19. The net operating income comes at 136,640. We have used 4.65 capitalization rate. Based on that, estimated market value comes at 2,938,000. Page 5, you can see the rent comparables. Model rent supported by the rent comparables. Page 6, capitalization rates. Those are model-driven capitalization rate. And page 7, capitalization rate evidence. This is those capitalization rate evidence supported by model-driven capitalization rate. And I have to mention also this is 2016 building. So page 8, Municipal Assessment Act excerpt. Page 9, a picture of the building. This is kind of the same building we had we have in Dockett. I think that's the second one in this docket. So this is the exterior picture of the building. And then page 10, interior. This is kind of a new layout inside. So page 13, stabilization rate. Sorry, my stabilization there. You can see they have higher vacancy, and the vacancy going up and up, and also they don't have much like maintenance and repair, but their advertising is very low. I believe like, so another thing I have to mention, if I use their potential rent, and if I use market vacancy rate, the effective gross income comes at 233,004. That means that's higher. The difference is 15,559. Like because in here I got the average from effective gross income. So basically, the estimated property value supported our model-driven estimated value. So I believe in here too, this is kind of a poor management. That's why their vacancy rate going higher and higher, because we don't see that things around the market there. So page 14, 16, 17, 18, up to page 23, their income and expense information. I believe 2,938,000 is fair value for the property. This concludes my presentation. Thank you.
Any questions, Mr. Rammer?
Again, Mr. Assessor, this is model driven from top to bottom on your page 4, correct?
That's right.
Mr. Chairman, that's my only question. Thank you.
Okay, Ms. Burhan, questions?
No, thank you, Mr. Chair.
Mr. Robson?
No, Mr. Chair, no question.
All right, you can begin, Mr. Rammer.
Page 15, please.
All
So,
right.
Mr. Chairman, in this case, we've got a slight difference in NOI. We're coming in at $130,066 relative to the department's $136,640. Getting there by very different means. Our vacancies higher, but our expenses are also significantly lower than the modeled expenses. So at the end of the day, there is a difference, but not a significant difference. In that, I'll leave it with the board to decide as between our NOI of 130 versus the department's at 136.5 roughly. The capitalization rate we're applying, which is the lowest rate that we believe is indicated by our analysis, and our cap rate is 5.00%, and ask the board to reduce the subject to $2,601,000. Thank you.
Okay, questions, Mr. Assessor?
No question. Thank you.
Mr. Robson?
No questions.
Ms. Burhan?
No questions, sir. Thank you.
Okay, the question I've got, and I guess it applies to Street 20 Stradbrook as well. Why are these properties, which are the newest, and they seem to be quite modern and attractive looking on the inside, at least from the pictures, why are they underperforming in terms of vacancy?
And I've heard the assessor's comments about the mismanagement, and which is based on the advertising expense. And I'd suggest a person who's invested the money to build these brand new things and have them on the market is going to be very active in marketing them. The only thing I can tell you, Mr. Chairman, it seems to be a function of the market and the price point for these units at these locations, and they're just not performing well. The vacancy rates are pretty. Now you do have a smaller number of units, which of course is going to cause huge variations in the actual vacancy. It's not like a 90 or 100 unit property where one or two vacant, right? This I would suggest you very strongly. No one in there, no one who's got any sort of business acumen and investment acumen is going to just allow their units to sit vacant for obvious reasons. And the correlation between that and the advertising expense, I would suggest that these owners have been doing their best to market them, but it's not reflected in the actual. They've basically, my suggestion would be they've coded or put the actual advertising expenses under a different category, because $10 in advertising for a building that in this case is 18% vacant, it just doesn't make any sense to me. But I suggest to you it is market driven at the end of the day.
So you're saying it's the wrong product in the wrong location.
Yeah, at the wrong price point. Yeah. Exactly right. Yeah.
Okay, thank you very much for that. We've now heard all the properties on today's agenda, so this hearing is now adjourned. Thank you, gentlemen, for your very capable presentations as usual.
Thank you very much.
Thank you very much. Have a good day, everyone.
Bye.
Thank
Thank you. And then we'll just take a short break and the board will come back and deliberate.